Welcome into another Tax Talker. Here's a quick question. You donate $1,000 to charity before year end. How much are you going to save in taxes? Well, of course the answer is it depends, but for the majority of Americans, the answer to that is zero or near zero. But it could also be in excess of $300. Today we're talking about itemized deductions and the cliff between benefit and no benefit, and how to plan around it. Let's get into it. We're starting to talk about below the line deductions. That means itemized deductions. These are deductions that you may benefit from, but it depends on your total situation. Because everyone has the choice between the standard deduction and itemizing their deductions. The standard deduction is just a posted amount. It's adjusted for inflation each year. They're on screen here, but you can see for a married couple, that's $31,500. And for a single person, it's $15,750. For most people, this is their main write-off in going from adjusted gross income to taxable income. Now, itemized deductions are specific to the individual, and it's a matter of, do the sum of these different tax preferential items, are those greater than the standard deduction? Well, then you can itemize. The main ones are the state and local tax deduction. This is mainly your state property taxes and state income taxes, also your car tabs. Now you'll note this used to be capped. From 2018 through 2024, this was limited to $10,000. Now, as long as your income's below $500,000, you can deduct up to $40,000 in state and local tax deduction. This is also, when you hear it debated in the news, you'll often hear the SALT cap. This is what this refers to. Next, you have your mortgage interest. This is interest on up to $750,000 of total loan. Now, if your loan is over that amount, you don't lose the whole deduction, it just gets prorated. Then you get into your charitable giving. This is both cash donations and your non-cash donations. So the sum of those big three is going to make up your itemized deductions for most people. You also can throw in medical expenses, but there's a big floor here. You're only going to start benefiting to the extent your medical expenses are over 7.5% of your adjusted gross income. So if your adjusted gross income, your AGI is $100,000, then you need at least $7,500 to start benefiting from medical. Your medical expenses were $10,000, well then you'll get the $2,500 will go into that broader pool of itemized deductions. The sum of these, if they don't equal the standard deduction, then you're still better off taking the standard. I think there were a whole lot of people that were very used to thinking of themselves as itemizers, and then following the 2017 Tax Cuts and Jobs Act, they no longer were, or it was very close. And I think this is an important concept. This goes into that cliff effect. If your itemized deductions are just right around the standard, it's kind of meaningless to say you're benefiting from them, right? Because you could just as easily be taking the standard. Let's put this into a real example. If you have state and local tax deduction of $15,000, mortgage interest of $10,000, and charitable donations of $5,000, you're at $30,000 of itemized deduction. And so there's still no benefit if you're a married couple to itemizing your deductions, because your standard deduction is $31,500. Going back to the question we started with, if that couple donated $1,000 before year end, what would their tax benefit be? It would be zero. It would be $0. They'd be up to $31,000 of itemized, but they'd still be below the $31,500. Now, as I said from the beginning, that number gets bumped every year based on inflation, and actually got a bigger bump as part of the One Big Beautiful Bill than normal. So this number has been going up each year. This couple, if that's their typical situation, they may have been a little bit better than itemizing when the standard deduction was more like $27,000 or $28,000. Without any tax planning, their behavior is not changing. They would have done this regardless. And so, yeah, they might be a little bit better off in 1 year itemizing, a little bit better off in 1 year taking the standard deduction. But by being a little bit more proactive, you can get a bigger benefit. The main thing here is bunching your charitable donations. If you're someone with recurring charitable intent, this can be a powerful tool to use, especially if you're right around that itemized versus standard threshold. If every year I give about $5,000 to various charities, I tend to do that towards year end anyway. As I approach the end of 2025, I might wait on those. I might make those actually January 2026 deduction. And then come the end of 2026, I'll do the opposite. I'll make sure to get them in before 12/31/2026. What have I done? Over a 2-year period, I haven't really changed my charitable giving. I've just changed the timing such that instead of having a $5,000 deduction in 25 and a $5,000 deduction in 26, I've made that close to a $10,000 deduction in 2026, depending on how much I can push those in to 2026. And if we return to that example earlier, $10,000 of charity in 1 year, and then in the following year just take a standard deduction, well, that would be a big savings for a taxpayer. But you can supercharge this even more with a donor-advised fund. This is a charitable investment account. You make one big donation into the fund, you get the full tax deduction in the year of putting in the fund. And then you can use the fund to make donations. Those are not part of your donations in subsequent years. So this can be a way to have an even larger charitable donation without having the onus of actually giving a big chunk of money to one charity at one moment in time. Really, any of your major brokerage houses like Fidelity and Schwab are going to have these accounts. You do just legitimately want to have charitable intent. You don't just want to park these funds because you really do not have ultimate control over that charitable account. If you're just not using the account for charitable purposes, the brokerage firm can actually step in and make donations. The other thing with itemized deductions, it used to be a very common strategy before the Tax Cuts and Jobs Act, and now it will be back. It's making sure if you are going to owe state income taxes, pay that ahead of 12/31. Similarly, it depends on the timing of your property taxes, but you might be able to accelerate those before year end as well. Again, these were all the below the line deductions. These are ways to make sure you're getting the bang for your buck on itemized deductions over the standard deduction. The overall important concept is it's not that great to just make sure you itemize every year. It's far better to try to pad it, make sure, okay, this is a year of big itemized deductions, this year we'll take the standard, and so on. Once you pass that cliff of being greater than the standard deduction, well then let's get as much into that year as possible. Moving along to your above the line deduction, these are items that reduce adjusted gross income regardless of itemizing or not. So you're gonna benefit right away. The most obvious example of this is your pre-tax retirement contributions and HSA and FSA contributions. Also, the new rules under the One Big Beautiful Bill. Your no tax on overtime, your no tax on tips, your vehicle interest deduction. These are all items that get deducted in arriving at adjusted gross income. You don't have to worry about itemizing. There's also a new above the line charitable donation deduction. I think it's $1,000 for a married couple, $500 for a single person. So if you're not itemizing, you still can get a little benefit from your charitable. Now the items where you really have a lot more control is your 401k, your retirement contributions, and your HSA contributions. Now for 401k, these need to be made through your payroll before year end. So your final paycheck for this year is your last chance to get a deduction within the calendar year 2025. For HSA, you should be able to make a manual contribution even after 12/31. They follow the IRA rules where you have until the deadline of the return to make a contribution. Just note, you're not going to be saving your FICA taxes. If you do it through payroll, you get to save on payroll taxes as well. IRA deductions, that also you have until April 15th. But just note the income limitations here. If you have access to an employer-sponsored plan, then the income limits are relatively low. At $90,000 single, you'll be fully phased out of a deduction, and I think 146 married, you'll be fully phased out of a deduction. You can still contribute to an IRA, you're just not getting any deduction for it. Now, if your spouse has access to a retirement plan, but you do not, those income limits are much higher. But those are the key items in reducing your income. And again, a deduction pre-tax like that happening on your pay stub, it doesn't feel like it. You don't see it in the same way you see your itemized deductions, but in the same way you reduce income, that's reducing what's exposed to then the tax rate that you're in. So in terms of tax savings, it's just as good. And for many people, it's better, especially if they're not itemized. So that is the Tax Talker for today. It's important to know whether you itemize or whether you're taking the standard deduction in a given year. And it's great to bunch the timing on a year where you're taking the itemized, maybe make that a high charitable donation year. Be sure to drop me a comment. Love to know what tax planning questions you have before year end, and subscribe for more content. We'll be coming out with a lot of videos around tax planning and strategy as we approach 12/31. Thanks for watching.